Assalamualaikum warahmatullahi ta'ala wabarakatuh. Okay guys, today we go to chapter 5, which is a derivative market. Okay, derivative market. Okay, now what is a derivative? Derivative is a financial security with a value is rely upon or derived from an underlying asset. Okay, an underlying asset. Underlying asset. Okay, what are the example of underlying assets? Okay, the underlying assets for derivative normally is the stocks, bonds, commodities, currencies, interest rate, and market indexes. And all these underlying assets are commonly purchased through brokerage. Through brokerage. Derivative can be traded through two counter, which is over the counter or exchange traded counter. Over the counter is its derivative constitute a greater proportions of a derivative market, which normally this OTC is have a greater possibility or a counterparty risk. Whereas the ETD is more having a standard contract, and in Malaysia the contract is supervised by securities commissions, and all the transaction need to be through the clearing house. The clearing house, or we call as a Malaysia Bursa Malaysia Derivative Clearing House. Okay, but the OTC is more towards the custom made. Okay, now if we go further, you need to learn about the futures and options. Okay, the futures and options. Futures and options are two popular derivatives in a capital market. Futures and options. Okay, these two are popular derivative in a capital market. Okay, a futures contract can be on stock or indexes, or could be on the currencies. Now for minimal part, where we just focus on currencies, which is a foreign currencies, in a forex market. That's related to the futures. But options contract is normally we involve with the two type, which is a call and also put. Okay, this fin 542 we focus on the forex, the trading on the forex using a futures, and also trading of a forex using a options contract, which is named as a call and also put. Okay, this is the example of questions for a futures. Okay students, for futures we have two types. You need to identify the questions. Either the question asks you to perform a short contract or to perform a long contract. Okay, what is short for? Short is for a sell and long for a buy. Okay, a long for a buy. Now let's have a look on the question for a short, which is a sell, short. Okay, this is an example of question, very simple question. Okay, Mr. Adam Smith went short on March 22, 2010 by selling 5 futures. You need to underline the keywords. Selling 5 futures contract of Canadian dollar at opening price of USD 0.7208. Okay, means the Adam Smith opened the futures contract on the 22nd of March 2010, okay, by selling a 5 futures contract. He closed out the contract on the 25th of March, so 22, 3, 4, 5, only 4 days trading at a closing price of USD 0.7206, and the closing price on the March 22, 23 and 24 as stipulated price respectively. So the question asks you to calculate the profit or the losses of mark to market on the futures contract. Okay, for a futures question, you need to determine the opening price and also the closing price for a daily basis. Why you need to do so? Because every day the broker need to calculate the mark to market. What it means by mark to market? Mark to market is we need to calculate the daily profit and loss, because either that can generate either it's good enough for a margin or not enough for a margin. Okay, and I add another information. Okay, since we know this is a short contract selling, and the Adam Smith started the contract on the 22nd March and end up on the 25th March, only 4 days, and every day have a opening and a closing price, and they must have a price in the USD for a trading, but starting price could be another foreign currency. For this contract, we started with the Canadian dollar 5 futures contract, and then the customer must give you the standard value for a Canadian dollar to trade in the futures. So for this question, the Canadian dollar standard contract is 100,000. So let's say if the question extend further, they give you another information. They have the Adam Smith must pledge initial margin of USD 2,500 and must maintain the minimum margin of USD 1,000. So how we should do futures calculations? It's a little bit tricky. Okay, this is a very tedious work, I would say, but it's very easy for you to score marks. What you can do is you need to extend 1, 2, 3, 4, 4 columns. Yeah, 4 columns. The first column is you need to write up the date or the day of the trading and the activity, followed by a cash flow, and the last column is a margin account calculation. Okay. If you refer back to the question, they started on the 22nd of March and end up on the 25th of March. Okay, they have a 2-2. This is a morning. For your information, when we started our contract, they have a morning, they have a closing, and the day after closing, and a closing. Okay. Now, first thing foremost, you before you start to calculate the table, you need first you need to write up just like this. Yeah, you need to write up. You need to write Mr. Adam Smith short. Why we need to write a short? Because to bear in mind, this is a selling futures contract. Short what? Short 5 futures contract, Canadian dollar. So the standard value for a Canadian dollar for this question is 100,000. So if you have 5 futures contract, the number of futures contract, so you need to times with number of futures contract. Means before you start, you need to know the standard contract for that particular foreign currency, and you need to times with the number of contract. For this question, Canadian dollar 100,000, I times with the 5 futures contract. So Adam Smith started with the future contract is a 500,000. Okay, now on the first day, write up the 22nd of March. My activity is a sell. You need to write the sell keywords. Yeah, sell what? Sell CAD. Sell CAD 500,000 at what? At 0.7208. where information is that this one, yeah, they mention at the opening price of 0.7208, and they kata the closing price on the March 22 is a 0.7234. This is the opening for 22 and this is a closing for a 22. So that's why I write it back. This is opening 0.7208 and the 22nd of March this is a closing 0.7234. Okay, I write sell CAD 500,000 at USD 0.7208. At a column of cash flow, you need to write no profit and no loss. This is, you will gain a mark, 1 mark, yeah. Okay, and then we started with a margin 2,500. Okay, 2,500. And then on the 22nd of March, at 2 p.m. we need to close the market. So you calculate this. We started with the CAD 500,000, then the transaction must be in the USD. So CAD 500,000 we times with the USD 0.7208. So the opening contract is a USD 360 for 100,000 after conversion to USD. Okay, this is the morning. So at 2 p.m. what happened to the futures price? At the morning the price is 0.7208, but when they are closing the price shoot up to 0.7234. Okay, then you need to write up futures price increase 0.7234. As a logic, in the morning you already sold at 0.7208. If the futures price increase 7234, means you will incur loss. Why loss? Because you already sold at the lower price 7208, and the closing you need to buy. So means this is your sell price, this is your buy price. Your buy price is much higher than your sell price. Okay, that's a logic. Okay, so we need to calculate the cash flow. Okay, you need to bear in mind, take the original contract value. Take the original contract, which is a 500,000. Okay, so how to calculate the cash flow? You, for a sell, for a short, you take this price minus with this price, means sell minus buy. Okay, and this is a standard contract value. Always a rule of thumb for your futures, sell price minus with the buy price times the standard contract value. So if the sell price on the up stage, so the up price minus with the bottom price. So this is up price 7208 minus with the bottom price, which means atas minus with the bawah times with the standard contract 500,000. Yeah, that's a rule of thumb. Atas minus bawah and times with the contract of standard contract value, then they will gain a loss 1,300. Okay, so since they need to pledge a margin account 2,500, so since the broker already marked to market negatives, and that on the 22nd of March the Adam Smith gain loss 1,300, they will deduct from a margin account 2,500 minus with 1,300, then the margin account have a balance 1,200. Okay, now we go for a second day of the trading, 23rd of March. Okay, what happened to the price? On the 22nd of March, the price closing at 7234, and the 23rd the price closing at 7257. Okay, 7257. That's why you can see here I put futures price increase 7257. Okay, why increase? Because we compare a price a day before. A price a day before would be a opening price, and this is a closing price, means this is a selling for a 23rd March, this is a buying for a 23rd March. Okay, so rule of thumb here, again, if you sell at 7234 and when you buy it would be 7257, So means you will incur loss. So again, atas tolak bawah, 7234 you minus 7257 times with standard, you will gain a loss. Okay, we got a loss 1150. So for a margin, we take 1200 before a day, and then we minus with 1150, and then the balance of margin only have 50 USD. So what happened? So since the question as the Adam Smith must have the minimum margin of USD 1000, so the broker will make a margin call. If the margin balances is not up to the standard of minimum margin 1000, so the broker need to make a margin call. That's why for this situation, the broker of Adam Smith make a margin call the Adam to top up how much? To top up 2500 minus with 50, so the Adam Smith need to top up another 2450 to make it the margin accounts at a 2500 back. Okay, so means if the Adam Smith said I don't have money, so means the broker have the right to just close out the contract. Instead of proceed till the 25th of March, they will close or settle the contract at the 23rd of March. Okay, since for this situation, Adam Smith can afford to pay the margin call, so they proceed to the 24th of March. So what happened to 24th of March closing price? There would be a 7222. Okay, what happened to the price? This is a sell, this is the buy. So means they sell at 7257, buy at 722. So as a logic, if the futures price reduce, so the Adam Smith will gain a profit. Again, atas minus with the bawah times the 500,000, so they will get a profit 1750. So 2500 plus 1750, so they will have an accumulate of a margin balance of 4250, and the profit for the last day 25th of March, 25th of March, okay, 25th of March, where is the 20? Yeah, this is 25th of March. The closing price will be 7206. So that's why I write here 7206. Okay, what happened to the future price? Again, the futures price dropped, so means that we will gain a profit because sell 7222 and buy at 7206. 7222 minus 7206, I times the standard contract 500,000, so the Adam Smith will get profit of 800. So 4250, I plus with the 800, I will get margin account balance is 5050. So the last part you need to calculate is on the settlement day, the two things you need to calculate. One is the position mark to market, which is the cash flow, and another one is a contract settle. Just like at the beginning of the contract, we need to write out the opening contract, this 0400, and the last day we need to calculate the contract settle. How to calculate the contract settle is you take the CEAD 500,000 times with the closing price on the last day 7206. That's why you will get the USD 360,300. Okay, 360,300. Okay, now after we calculate all those things, we done the cash flow, mark to market, daily basis, and we done for a margin. The rest of the things is you need to calculate how much the profit and loss of the overall mark to market from 22 to 25th. Okay, the perfect way to calculate is either profit or loss. Okay, you take this one, okay, cash flow daily basis, you take 1300, okay, you plus with 1150, and then you plus with 1750, and then plus with 800. Just take the mark to market cash flow 1, 2, 3, 4. Don't take this one and don't take this one. Okay, this only these four things, and then please total it up. 1,300, 1,300, I plus with 1150 negative, plus 1750, plus 800, so end up I will gain 100 profit. Okay, 100 profit. So this is the perfect way to calculate the total of profit and loss. So first way to calculate the profit and loss. Okay, so actually before you construct the table, you should know how much I should get the profit and loss at the end of the day. The way to calculate it by using, you take the opening price, which is 0.7208, and you take the last closing price, which is a 0.7206. okay, this one and this one. So before you construct your table, you calculate first how much my ending, how much I should get my profit and loss. Okay, and then by doing that, you can counter back your answer, is it correct or not. So this rule of thumb, since this is the short, which is sell atas, harga atas minus with harga bawah, with times with the standard contract. So you take this one, 0.7208, you minus with the harga bawah, okay, and then you times back with the 500,000. So you should get a profit 100. Okay, that's the first way. And the second way is to calculate by using, since this is atas tolak bawah, okay, you take the atas, the opening contract in the USD, you tolak with the bawah closing or the settlement contract minus 360,300, and definitely you will get the same answer, positive 100. Okay, that is the second way of a calculation. But again, the perfect, you need to calculate your profit and loss by accumulate the day to day cash flow. Okay, the two ways, another two ways is just to counter back your answer. Is it your calculations on a mark to market correct or incorrect? Okay, just now we settled about futures contract for a short, which is sell, and this one is for a long or for buy, long buy. Okay, so I just twist the question, I just change it to Sarah Adam instead of Adam Smith. I change it to Sarah Adam, but I'm still using the same price and the same date and the same standard contract, and I will prove to you what happened to the futures contract when the decision we start with a long instead of sell. Okay, for a sell short for Adam Smith case, we'll get at the end of the day will get the profit of 100 USD. So what happened to this Sarah Adam if they start with a long, which is a buy? Okay, the same set of questions, just change it Sarah Adam and just change it the decision of long. Okay, this is just the same one, and then look how should we construct the same construct. Okay, we need to develop 4 contracts, and this one I start with a Sarah Adam long 5 futures contract, CED 100,000 times 500, so the original one is CED 500,000. Okay, the same things, 2, 2, 3, 2, 4, 2, 5. Okay, but this one I put buy instead of sell, buy. CED 500,000 and the same thing, same things. Okay, the futures price increase, drop. Okay, so let's see how. So in the morning of the 2 March, okay, Sarah Adam start with a buy. At the closing, the price shoot up. Okay, means the rule of thumb, remember, sell minus buy time with the standard contract value, which is the 500,000. So this not be a sell, this gonna be a buy, this gonna be the sell price. So still again, the rule of thumb, you need to sell minus buy. So for a short tadi atas minus with the bawah, but for buy, bawah we minus with the atas. Why bawah? Because the bawah is the sell price, the atas is the buy price. Okay, remember, bawah minus with the atas and then times with the standard contract value. Alright, so this is now profit and loss. You need to write up the margin is 2,500. So at the closing price, the price has shoot up. So bila price shoot up, we buy at the lower price. When the price has shoot up, we gain a profit because we sell at the high price. So gain profit 500,000. So just like I said, the bawah minus with the atas. So I take the bawah one 7234 minus with 7208 times with the original 500,000. So I gain profit 1,300. So how I get the 3,800, 2,500? I plus, since I gain a profit, Sarah Adam gain a profit, I plus with the 1,300, so got 3,800. How about 23rd March? This is buy, this is sell. How the price shoot up, so I'll gain profit. So 7257 bawah tolak atas, so I get 1150. So plus 4950. So what happened to the 24th of March? The price is dwindle or depreciate. Okay, so definitely gain loss because I buy at a high price, and when the closing up the price at they sell at the low price. So 7222 I minus 7257 so got negative 1750, but still under margin, still maintain the margin for 950. We minus 1750, we still at a 3,200. No need to make any margin call because still exceed 1,000. So on the 25th of March, the price still lower down, so gain a loss 7206 minus 7222 times 500,000, then we'll gain loss 800. So what happened to the margin? 3,200 minus 800, still within 2,400, within the minimum margin of 1,000. No need to make any margin call. Okay, then we need to kira all the contract settle 500,000 we times with 7206 and then get 3,360 300. So now we need to calculate profit and loss. Okay, 1,300 we plus with 1,150, we plus with negative 1,750, and then we plus with negative 800, and then we calculate 1,300 plus 1,150, 1,750, 800, and then we get a loss of 100. Okay, loss of 100. With the same set of question, if we twist decision instead of sell, which is a short, we twist decision to long, which is a buy. If we end up with a short, if we start with a short or sell, we gain a profit, but if we start with long or buy, we gain a loss with the same figure. Okay, and counter back your calculations. You take the bawah minus with the atas, bawah 0.7206, we minus with the atas 7208, we time with 100,000, you will get the negative 100. Same, yeah, negative 100, the same one. And another way to calculate it, the bawah 360,300, we minus with the atas 3,000, 400, and then the same things, negative 100. Okay, all right. Okay, now we proceed with options. Okay, options. What is options? The differences in between options and forward. Okay, forward is the obligations to settle the contract or to make the contract, but the options is give the investors the right, yeah, the right, but not the obligation, yeah, give the right, not obligations, either to buy or to sell. Okay, the contract at the very specific price at any time. Okay, for options we have two type. Either you proceed with the call or we proceed with the put. Okay, what is call? Call for a buy and put for a sell. Okay, to make it to avoid any confusing, how you want to ensure call is for buy. Okay, means why you need to call the pakcik jual ice cream? Because we need to buy the ice cream. That's why we call the pakcik to buy the ice cream. Why you need to put the ice cream on the rack? Why you need to put the ice cream on the rack? Because we need to sell the ice cream. If you put the something on the rack, definitely you want to sell the things. But if you call the pakcik to buy the ice cream, because we need to buy the ice cream. Okay, means call for a buy, put for sell. Okay, in the options we have American type and also European types. Yeah, what are the differences in between American and European? American and European. Okay, American is a free means if someone hold the options for American style, they can exercise that option at any time upon maturity, till maturity. Okay, can exercise at any time. But for European style, you can only exercise at the maturity period. Okay, for Malaysian market, we implement this European style. Okay, remember American is a free, means you can exercise at any time upon the maturity period, but for European style is a very strict, you only have the right to exercise it at maturity period. Okay guys, all right. So status of options. Status of options, we have a three status. It means either it's in the money, out the money, or at the money. What it means by in the money? In means profit, out means loss, at means break even. This one, yeah. Call for buy, put for sell. Okay, and then to make sure profit. Okay, before I forgot, option you need to identify the three prices. They must have the spot price, which is a market price. They must have a strike price, or we call as a exercise price, and another price is a premium. Premium is a cost that you need to pay to the broker. Okay, so in order to have the in the money positions, the spot must better than strike or exercise price. Or for a put, you must make sure strike must better than spot. Okay, and definitely if we want to exercise the call option, you found the strike bigger than spot, so definitely your option will in or out of the money. Same goes to put options. So for you to calculate the profit and loss for a call options, you need to using this formula, contract value, standard contract value, and then spot price minus strike price minus with the premium. Alright, for put contract value, strike minus spot minus premium. Okay, this if we exercise. Okay, remember for options you have the right, not obligation, to exercise or not exercise. Yeah, not same with the forward, you need to exercise. Yeah, you obligation you to exercise, but for options you have the two options, either you want to exercise it or you don't want to exercise, or we call as a whole. Okay, hold. So if we hold, you take the contract value times with the premium price. Same contract value times the premium. Okay, and then the last you need to make a decision. This one also decision. Either you want to exercise or not to exercise or to hold. Same. Okay, definitely you will choose the higher one. The higher lah. Okay, you compare with these two answer. If this one you gain a profit of 1,000, this one you hold, you need to pay. Yeah, if you hold, you need to pay the premium to the brokerage, which means you need to pay the cost. So definitely this is a cost you need to pay with cash outflow. So this is, we assume it's a loss. So definitely you will prefer exercise. But if you calculate the exercise is a negative 1,000, the whole is negative 500, better we hold because we only incur cost of negative 500 instead of we exercise we gain loss of 1,000. Okay, faham? Alright. Okay, this is example of options market question. Okay, for a call options, please highlight what the question asks you to calculate, either it's call options or put options. So remember, this is a call options. Okay, call options. When we talk about call, it means a buy. So for you to make a money in the money situation, you must make sure your spot must bigger than your strike. That's a very informations or data that you need to highlight. Okay, so look at the question. Okay, Citicorp call option. This is, they start with the Australian dollar. This contract value 500,000. Just like I said before, you need to determine the three prices: the premium, which is cost, the exercise price, or they sometimes use the strike price, and another one is spot price, or sometimes they use a market price. Okay, premium 0.03, and we write premium 0.03. Okay, exercise price is 0.70, and the spot price is 0.74. Okay, just glance, you can see we can gain a in the money situation, because if you hold the rule of thumb, we want to make sure that spot price is bigger than the exercise price without considering any premium price. Okay, so by looking into these two prices, looks like it good. 74 compared to 70, maybe we will up with the profit. So, and then they ask you to calculate loss and call options. So first, if I want to exercise, okay, since this is a call options, so I calculate. This is standard format, means a contract. I start with a call, means one contract. Yeah, one contract. Remember, just like a futures, you need to times with number of contract. If this is a 5 contract, so 5 times with the standard contract 500,000. Okay, remember. So if they only means one contract, means 500,000. So I write AD 500,000. Then my SO minus with the my EX and minus my premium. Okay, I get 500,000. My EX is in USD. Same like futures, your transaction must be in the USD. 74 minus 0.70 minus 0.03, and then calculate. 0.74 minus 0.70, I minus with 0.03, I try with 500,000, so I'll get a profit of 5,000 USD. Okay, this one if I exercise. How about if I hold? I hold Australian dollar 500,000, I times with the premium cost 0.03. So if I hold, I need to pay 15,000 USD. So decision. So my decision, definitely you have a decision, right? If I exercise, I gain profit of 5,000. But if I hold, I don't want to exercise, I will pay the broker 15,000 USD, which is, this is a cost. So definitely I will exercise because I will gain a profit of 5,000 instead of I hold, I will need to pay the cost of 15,000. Okay guys, that's a very straightforward calculation. So remember, tips, if the question not mentioned, this one is a premium price, this one is premium, they're not mentioned, they just mention Australian dollar at a price of USD 0.03. Okay, they mention about the strike, they mention about the spot. So how you want to determine this one is actually a premium or a cost price? You see the value is much difference, yeah, huge difference. The strike is likely not so much different with the spot price, so 7470, but you see the premium is much lower, 0.03. So it's trigger you that one is a premium. All right. Okay, another one, if the question asks you to calculate the break even, how to calculate the break even for a call options? Okay, since follow the same formula, we spot minus with the strike, and then it's must equivalent with the premium. If put the strike minus with the spot equivalent with the premium. Okay, for this question, if the question extend the question, they need to, for you to calculate the break even for a spot, and then they ask you how much the spot price the call option should be if the exercise price is the cost 0.70 and the premium is 0.03. They ask you about the spot price, so put it as spot minus the strike equivalent to premium. Okay, so we need to cari the spot minus strike 0.70 equivalent to 0.03. so how much the spot price? 0.7 we plus 0.03, so 0.73 means for these options to be in at the money or at the break even situation, the spot price should be in the 0.73. Okay, let's say we calculate 0.73, we minus with the 0.70, 0.73 minus 0.70 minus with 0.03. okay, so means we get nothing, zero. So either you exercise or not exercise, either you exercise, you should gain the same answer of 500,000. okay guys, so that's how you calculate for exercise, hold, and also for break even situations. Okay, till then, if the question asks you about the put option, the same things you need to do. How much the amount if you exercise, how much amount if you hold, and then make a decision. And then if the break even they ask you, so just put up like my formula. Okay, for a put, strike minus spot minus premium. For a call, spot minus strike minus premium. Alright, till then, khalas about futures and options. Do a lot of exercise. We will discuss it in our virtual class. I really hope that you guys happy have fun, have a fasting month, a great fasting month, and happy Ramadan and selamat Hari Raya in advance. Assalamualaikum warahmatullahi taala wabarakatuh.